Did you know that over 90% of people who invest in the stock market lose money? But what if you could be part of the 10% that wins big? In today's video, I'm going to reveal the ultimate strategies to help you master the stock market and transform your financial future. And stick around until the end because I've got a special bonus tip that could drastically change the way you invest. This is the Next Millionaire channel, your premier source for personal finance and wealth-building wisdom. So let's dive into this game-changing content. 1. Educate yourself. Education is the cornerstone of successful investing. Before diving into the stock market, it's crucial to understand its fundamentals. Start with foundational books like The Intelligent Investor by Benjamin Graham and A Random Walk Down Wall Street by Burton G. Malkiel. These books will introduce you to essential concepts such as value investing, market efficiency, and risk management. Online courses on platforms like Coursera, Udemy, or Khan Academy can also help you build a strong investment foundation. Imagine you're building a skyscraper. Without a solid foundation, it doesn't matter how tall or beautiful the structure is. It will eventually collapse. The same principle applies to investing. A strong educational foundation is crucial for long-term success. 2. Set clear goals. Setting clear financial goals is your roadmap to success. Are you investing for retirement, a major purchase, or simply to grow your wealth? Knowing your objectives will help guide your investment strategy. For instance, if you're saving for retirement, you might focus on long-term growth stocks and bonds. If you're saving for a down payment on a house in the next 5 years, you might prioritize less volatile investments. Think of setting goals as planning a road trip. You wouldn't just get in the car and drive aimlessly. Instead, you'd decide on a destination, plan your route, and make sure you have enough fuel to get there. Clear goals give your investment strategy direction and purpose. 3. Create a diversified portfolio. Diversification is a key strategy to reduce risk and increase the likelihood of achieving your financial goals. Spread your investments across different sectors and asset classes to minimize risk. This way, if one investment underperforms, others can help balance your portfolio. Don't limit your diversification to just stocks. Consider bonds, real estate, and even international markets. Imagine you're at a buffet. You wouldn't fill your plate with just one type of food. Instead, you'd sample a variety of dishes to ensure a balanced and satisfying meal. Diversification in investing works the same way. It helps balance your portfolio and reduce risk. 4. Understand risk tolerance. Every investor has a different risk tolerance. Assess your comfort level with risk and tailor your portfolio accordingly. This ensures you can weather market volatility without panicking. Use tools like risk tolerance questionnaires or consult with a financial advisor to determine your risk profile. Think of risk tolerance as your comfort with roller coasters. Some people love the thrill of high-speed drops and twists, while others prefer a more gentle ride. Understanding your risk tolerance helps you choose investments that align with your comfort level, ensuring a smoother investment journey. 5. Develop a long-term strategy. Investing is a marathon, not a sprint. Focus on long-term gains rather than short-term wins. Patience and discipline are key to success in the stock market. Avoid the temptation to chase quick profits and stick to your long-term plan. Historical data shows that the stock market tends to rise over the long term, despite short-term volatility. Consider the story of the tortoise and the hare. The hare may have been fast, but the tortoise's steady and consistent pace ultimately won the race. In investing, a slow and steady approach often leads to more reliable, long-term success. 6. Keep emotions in check. Emotions can be your worst enemy in investing. Fear and greed can lead to poor decisions. Stick to your strategy and avoid making impulsive moves based on market fluctuations. Develop a disciplined approach and remember that market downturns are a natural part of investing. Avoid panic selling during market dips and resist the urge to buy into hype during market peaks. Think of investing like a game of chess. Success requires patience, strategy, and the ability to think several moves ahead. Acting on emotions, like making impulsive moves in chess, can lead to mistakes and missed opportunities. 7. Regularly review and adjust your portfolio. Markets change, and so should your portfolio. Regularly review your investments and make adjustments as needed to stay aligned with your goals and market conditions. Rebalancing your portfolio annually or semi-annually can help ensure your asset allocation remains in line with your risk tolerance and financial objectives. Think of your portfolio like a garden. Regular maintenance, like weeding and pruning, ensures your plants grow healthy and strong. Similarly, reviewing and adjusting your portfolio helps keep your investments on track and thriving. 8. Stay informed and adapt. Staying informed is essential for making sound investment decisions. Keep up with market news, economic indicators, and global events. Being informed allows you to make timely decisions and adapt your strategy as needed. Follow reputable financial news sources, subscribe to investment newsletters, and consider joining investment communities to stay informed. Imagine you're sailing a boat. You need to be aware of changing weather conditions to adjust your sails and stay on course. In investing, staying informed about market conditions helps you navigate your investments more effectively. 9. Leverage technology. Technology can be a powerful ally in your investment journey. Here are some tools every investor should consider. Money tracking apps. Apps like Mint and Personal Capital help you monitor spending, set budgets, and track your net worth. These insights allow you to save and invest more effectively. Investment platforms. Platforms like Robinhood, E-Trade, and TD Ameritrade offer real-time data, research tools, and seamless trading to manage your portfolio with ease. Robo-advisors. Services like Betterment and Wealthfront use algorithms to create and manage diversified portfolios tailored to your goals, providing a hands-off approach to investing. Stock analysis tools. Platforms like Morningstar and Zacks Investment Research provide in-depth analysis, ratings, and recommendations to help you evaluate potential investments. Crypto tools. For cryptocurrency investors, wallets and exchanges like Coinbase and Binance offer secure storage and detailed market insights. Financial news apps. Apps like Bloomberg and CNBC keep you updated with the latest market news and expert analysis, helping you stay informed about market movements. Technology is your co-pilot in the investment world. Use these tools to navigate the financial markets with confidence and precision, optimizing your strategy and achieving your financial goals more efficiently. 10. Seek professional advice when needed. Don't hesitate to seek professional advice when needed. A financial advisor can provide personalized guidance and help you navigate complex investment decisions. They can also offer a second opinion and help you stay disciplined during turbulent market periods. Consider a financial advisor as your personal fitness trainer. Just as a trainer helps you achieve your fitness goals with tailored advice and support, a financial advisor can help you reach your financial goals with expert guidance and personalized strategies. Mid-roll call to action, CTA. If you're finding these tips helpful, make sure to smash that like button and drop a comment below with your thoughts. And if you haven't already, subscribe to The Next Millionaire for more valuable insights on building wealth. Quick quiz time. What's the most important factor in long-term investing success? Is it A, timing the market, B, diversification, or C, following hot stock tips? Drop your answer in the comments below. I'll reveal the correct answer at the end of the video. Special bonus tip. Storytelling approach. Mr. Buffett's journey now. Let's take a look at how one of the greatest investors of all time, Warren Buffett, took advantage of these stock market secrets. Mr. Buffett didn't become a billionaire overnight. He started with a clear goal: to build a substantial and sustainable fortune through smart investing. He educated himself by devouring every investment book he could find, particularly valuing The Intelligent Investor by Benjamin Graham. Buffett set clear financial goals, aiming for long-term wealth rather than short-term gains. He diversified his portfolio across different sectors and industries, understanding the importance of not putting all his eggs in one basket. His risk tolerance was carefully calibrated, allowing him to stay calm during market downturns and avoid rash decisions.
Buffett's long-term strategy, combined with his ability to keep emotions in check, led him to make some of the most iconic investments in history, such as his purchase of Coca-Cola and American Express stocks. He regularly reviewed and adjusted his portfolio, always staying informed and adapting to market changes. Even with all his success, Buffett still sought advice and collaboration from other financial experts, ensuring that he continued to make informed and strategic decisions. The key takeaway from Buffett's journey? Consistency, discipline, and a willingness to continuously learn and adapt are the cornerstones of successful investing. By following these principles, you too can set yourself on the path to financial success. Earlier in the video, I asked you what the most important factor in long-term investing success is. The options were A, timing the market, B, diversification, or C, following hot stock tips. The correct answer is B, diversification. Why? Diversification is key because it spreads your investments across different asset classes, industries, and regions. This reduces your overall risk by ensuring that the poor performance of a single investment won't drastically impact your entire portfolio. By diversifying, you create a more stable and resilient portfolio, which is essential for achieving steady long-term growth. If you found this video helpful, please give it a thumbs up, share it with friends who might benefit, and subscribe for more insights on personal finance and wealth building. So that's it, folks. Stay focused, stay motivated, and keep pushing forward. The next millionaire is you.